And here's the tree, right? Now the tree follows this, this formula that we've just developed. So we start with ROIC including goodwill. That's what we saw was the big difference. So this is 2013 ROIC with goodwill, UPS 16.9, FedEx 6.2. Then of course the first thing we do, let's look at it without goodwill. Possibly their operating return on invested capitals are the same, but FedEx has made a lot of acquisitions, and so they have a lot of goodwill and acquired intangibles, and that's dragging down their return with goodwill. So we look at it without goodwill, we take it out of invested capital, we look at just the operating measure, and we see that actually while that does improve FedEx's return, it also improves UPS return, and actually the difference is bigger here. So now UPS has a return without goodwill of about almost 19% and FedEx of almost 7%. And we can look at goodwill as a percentage of capital and see that actually UPS actually has more goodwill as a percent of invested capital, so they've made more acquisitions. It's not that big of a difference, but if anything, it's tilted towards UPS. So the next thing we do is we decompose ROIC without goodwill into these three parts, right? So the first thing we look at is, could it be a tax benefit? In other words, could UPS just be paying much lower taxes than FedEx because of some kind of financial structure that they have? And the fact that they're paying lower taxes means that they're going to have a higher return because the tax rate has a one-for-one impact on return. So we look at their operating tax rate, and we see that UPS does pay a slightly lower tax rate in 2013 than FedEx, 32.8 to 34.6 for FedEx. That's not a huge difference here. This is about a % difference, and so this can't be what's driving the large difference in return on invested capital. So we go up and we look at what we call pre-tax ROIC, which would just be operating margin and revenue divided by invested capital, which is capital efficiency, and we see that we still have a huge difference. In fact, we have an even bigger one. Pre-tax ROIC, meaning ROIC without 1 minus the tax rate, for UPS is almost 30%, and for FedEx is about 10. So now we're 2 times bigger, fully 3 times bigger. So we go every farther, right? The way the tree works is we keep decomposing every branch on the tree where we see a difference. And so here the difference is in the pre-tax ROIC, so we break that into its 2 component parts, which are the next 2 pieces of the formula. EBITDA divided by revenue, that's operating margin. And then revenue divided by invested capital, that's capital efficiency. And we see differences in both of these pieces. So we know we're going to have to go one more step on the tree to try and investigate what makes these differences. So we look at operating margin first, and we see that operating margin for UPS is 12.6%, for FedEx that's 9.8. Now this is a pretty big difference in margins, right? For every dollar, UPS is making 12.5 cents of operating profit, and FedEx is only making 9.8 cents in operating profit. That's a pretty stark difference here, and that could definitely be what's driving some of this difference in return. UPS is taking their revenue and turning it into profit at a better rate. Now, EBITDA, right, operating profit, is different from net income, but EBITDA is way up at the top of the income statement. Remember, go back and look at a simple income statement. It's revenue minus cost minus depreciation gives me EBITDA, right? So this is way up here at the top. So what we want to look at is all of the things between revenue and EBITDA, all of the costs that are on the income statement there. Let's see what any of those cost drivers, how they could be affecting margin. Because ultimately, the only way for UPS to have a higher margin is to have better control over its costs. And they're going to have approximately the same costs. Remember, these are companies that are close competitors. They're going to have income statements that look broadly similar. So we go back to the income statement. We see what are all the costs that come after revenue and before EBITDA, and those are compensation and benefits, purchase transportation, fuel, depreciation, and then other expenses. And so we break down as a percentage of revenue what do all of these cost items look like as a percentage of revenue. So we start with compensation and benefits. This is probably going to be the biggest cost driver for most firms. and we see compensation and benefits as a percentage of revenue, so we call this our labor costs. For UPS, 52%, FedEx, 36%. So actually, we see a difference that we wouldn't necessarily expect here. UPS has a much higher percentage of their revenue goes to compensation and benefits. Purchase transportation. Remember, this is these firms typically paying for or buying space on a different carrier, like the U.S. Postal Service, to deliver their packages the last mile. And both of these companies are engaged in it. We see FedEx is engaged in it a little bit more. About 17% of their costs is going towards purchase transportation. For UPS, only about 13%. Fuel, big expense for both companies, but we do see that FedEx is spending considerably more on fuel than UPS, 10% to 7.5 or 7.3, and that's a pretty significant difference. We wouldn't expect that, or at least I wouldn't expect that right on the face. So that's something we're going to have to look at more. Depreciation, again, we see FedEx here almost double in terms of depreciation to UPS. Right? And that would suggest that they've got a lot more assets, or that they have a lot more valuable assets, and that they're depreciating these valuable assets compared to UPS at a greater rate. And then if we look at other expenses, we see that, again, FedEx has other expenses that are almost double of what UPS is. And these other expenses are including things like airplane leases and landing fees and associated airport costs. And both these companies run huge air fleets because they do a lot of overnight and across the world shipping. So we look at all of these together, and what I want you to be thinking, and what we would be thinking if we were doing this analysis, is what's the story here? How do we tie all these numbers together to try and tell me, the investor or the manager, why UPS is overperforming relative to FedEx? So we look at that and we say, okay, UPS has more employees, but they have lower purchase transportation, they have lower fuel costs, they have less depreciation, and then they don't have as many of these associated costs with airport fees and landing fees and aircraft maintenance and all that stuff. And so we want to think about what that means. That obviously what two businesses that we thought were really similar are actually turning out to be a little more different. And that's actually the case when you look more in depth at what's going on here. It turns out that UPS has a bigger percentage of the door-to-door market, so they are more engaged in ground delivery, and that's why they have more employees. They have more employees because they're delivering trucks to houses more than FedEx. They have lower purchase transportation because, again, they're not paying USPS, the Postal Service, as much to deliver their packages to the last mile, and they're doing it more themselves. They have lower fuel costs because airline fuel is more expensive than truck fuel. They have lower depreciation because trucks are way cheaper than airplanes, and so their depreciation on trucks, which have lower value, is lower. And then because they don't fly as many planes, they have lower associated airline costs. And so the difference here is that FedEx has turned out to be focusing more on overnight delivery and airplane delivery, whereas UPS has been focused more on ground and person-to-person delivery. And this has caused a big diversion in their business, and obviously, as you can see here, in their associated operating costs. UPS has chosen the realm of or focused on the realm of the business that is cheaper to maintain, and that has caused FedEx to have lower margins. So clearly there's a difference here in terms of the operating margin, and we can see that the cost drivers have pointed out some major areas of concern. Now that may just be due to the fact that they've chosen sort of different lines of business in the same general avenue of business, which is they both deliver things, but UPS is sort of focused on the lower cost, higher margin ground-to-ground delivery, and FedEx is focused on the opposite, which is overnight delivery. And you know what? That may not have been how it originally was. It's possible that overnight delivery used to command a higher prices and better margins, and so that's why FedEx started to focus there, where UPS has always been a more traditionally ground-based person-to-person delivery company. And now that's shifted. We don't know yet. What it indicates to us is that there's a lot of places where FedEx could improve their cost structure, And it certainly is not this side of the tree. We're not done here. What we would want to do ideally is we'd want to go through each one of these branches and try to investigate it further if we could. So can we look at a more detailed breakdown of compensation and benefits for these two firms and see, how many more, does UPS actually have more employees? Are they paying their employees more? Can we figure out anything more about it? And it turns out, I won't actually show you this, but it turns out that this is actually true. UPS has about 340,000 employees and FedEx has about 190,000. So they do have significantly more employees, and we would try to find more information there. We'd try to find out more about fuel and purchase transportation and all those things that I told you, that airline fuel is more expensive than truck fuel, and that FedEx has more purchase transportation. All of those things are found out by not just by looking here at the income statement information, but by going into more detail and looking through the financial statements and trying to figure out what all of these differences are caused by. So we'll do a little bit here. We will do a more detailed analysis of compensation and benefits, but we should, in a real process, we'd do a more detailed analysis of each one of these branches. So there's a difference here for margins. We want to look at the flip side too. We look at capital efficiency, which is revenue divided by invested capital. And the way to think about this is, for every dollar of capital that I use to buy assets, how does that turn into revenue, right? Every asset that I own should be utilized to concretely to make revenue for the firm. If I buy some machinery for my factory, I should be using it to make products that I then sell to make revenue. And I shouldn't be using, for instance, the easiest way to think about comparing capital efficiency is if my firm and another firm both make the exact same thing. We both make bicycles and we both use the exact same machinery to make bicycles. Capital efficiency and a difference in that would mean that that firm can make twice as many bicycles with the same amount of machinery as I can. And somehow they've figured out a way to use their capital more efficiently than I did. So we look at this measure and we see a drastic difference for UPS versus FedEx. For every dollar of invested capital of assets, UPS is generating $2.24 in revenue, and FedEx is only generating $1.07, right? So on two plus times more capital efficiency for UPS. And this is almost certainly what's driving the difference in return, or the majority of it. And so we want to look more deeply into this. So the first thing we look at is what in terms of invested capital, there's really two parts. The first part of invested capital is working capital. The second part is fixed capital, right? So our fixed assets and our working assets. Invested capital is mostly just assets, and so these are the two parts of it. So we look at any difference in working capital, and we see that there isn't much of one. UPS, a percentage of revenue that goes to working capital, 3%, FedEx 3.4%. Again, not a huge difference here. The big difference comes in fixed assets. As a percentage of revenue, UPS has 41% fixed assets, and FedEx has 89.7%. And based on the story that we already have in mind for these two companies, this makes a lot of sense now, right? Trucks, UPS is ground-based delivery, so most of their fixed assets are trucks and warehouses and associated items they're facilitating their largely ground-based business. And FedEx has got airplanes and airports and runways and aircraft maintenance, along with all the other associated costs of trucks and other ground-based delivery, right? You can't deliver a package to the final person with an airplane. You can just take it from one city to the next. So if UPS does not have as many planes and associated fees there, if they're mostly doing long-haul trucking and freight shipping and things like that, their fixed assets are going to be much lower. And this is what feeds back into the costs up above in the margin section, right? And so we see that it may not be a fixable thing to say, let's say we've been hired by FedEx. How come our ROICs aren't as high as UPS? What can we do? Well, if we look at this analysis and we think about the way that the companies run, unless they're going to shift their attention to something else, they may not be able to increase their returns. In other words, returns aren't always just fixable. I've told you before that returns for like the grocery store industry are 3 to 5%. But we can't fix that. We can't change it. That's just the nature of it. They're a very capital intensive business. They have really low margins. They just can't have high returns. So if what we're looking at is defined by this, then FedEx and UPS may just be destined to have different returns because they're in different businesses than we thought. But again, here we have two things that we should go farther into. We should try to get a more detailed look at the fixed assets and make sure that our intuition here, that FedEx has more airplanes and more really high value fixed assets, is true. And so we want to go any deeper, and we'd want to go deeper into operating working capital. Okay, even though we don't observe a difference here, and this is important. This is an important thing to note. Even though we don't observe a difference in operating working capital at the top line, if we go into more detail and we look at the things that make up working capital, so all the line items of current assets and all the line items of current liabilities, do we observe any differences here that might tell us more about how the businesses are different? Because if the businesses are truly different, then we might have more of more room to say that this isn't something that FedEx can change in any real way. So what we'll do over the next couple of slides is we'll look at operating working capital in more detail, and then for a different set of firms we'll look at compensation and benefits, because UPS doesn't provide the right kind of information to go into more detail. And I want to show you an example of an industry that does provide more detail, and how we can use that detail to look at get a further analysis of what's going on.